Welcome to the NPWC Wealth Podcast, Episode 4. My name is Cody Novak, and our guest today is Greg Romundt. Greg is the founder, president, and CEO of Centurion Asset Management, which manages over $6.6 billion of capital. Greg is the portfolio manager of their flagship fund, the Centurion Apartment REIT, which has an average annual return of over 14% since its inception in 2009. Our office and our clients have gladly been long-term investors. So thank you very much, Greg, for doing such a terrific job managing this fund. And thank you for being here today.
Thank you. Appreciate your support, and I'm happy to be here.
Awesome. Now, first question, and the question that I get from investors and prospective investors is, how are they generating these returns, 14% on average since 2009? What is it taking to generate that type of return in your field? And is that common at all in apartment REITs?
Okay. Well, the easier question is it common? I think it is. I mean, if you look back, there's data that goes in the apartment industry of almost 40 years, showing that certainly on an unlevered basis, there hasn't actually been a negative return year in almost 40 years. That's not necessarily a promise, of course, of the future. It looks like the past, but there's a couple of things that really allowed us to get there. And one, I think, Canada has a lot of tailwinds, and our industry has a lot of tailwinds. Excess immigration creating a strong demand. We have, a significant shortage of housing, and we've had inflation that has been, certainly higher than the cost of funds. So when you think about real interest rates, and we talked about interest rates going up, but they're still negative in real terms, or after adjusting for inflation. And we're also in a business which is something that everyone needs, like a core needs industry. So you just kind of line up all these things, and we've got a lot of positive things going on. You label that with a discipline on how you select the investments that you make. So that's a very important aspect of what we do. And then, building a team around that, whose job it is always to be optimizing that, like, focusing on things where we can reduce expenses, like, whether for a value add type project, that might be windows, might be boilers, might be new roofs, it might be new water saving or electricity saving programs. Then there's things that can drive top lines too, like renovations and, positive marketing of those suites. So it's not just, you take it from a couple of angles. It's the right industry, it's the right time to be in the industry. It is, a monetary policy that's conducive to success in that industry. It's proper asset selection, and then optimization and building a team around it. So we just, it's a lot of cylinders, but we're kind of been fortunate enough to be firing on all of those.
Mm-hmm. Awesome. I'll just pull up your fun fact sheet here, so viewers can kind of take a look and see kind of the year to year and total returns there. I'll just zoom in a little bit. And you were mentioning that there's a lot of tailwinds, throughout your history in the business and running this investment. And sometimes we'll talk to a prospective investor and we'll say, hey, we don't want to forward look for a 14+% return, because we want to set more realistic expectations. Even if 14% was achievable consistency long term, I don't really know. But they'll say, how can they continue to perform at above 10% moving forward? So do you see those tailwinds continuing, and how do you see forward-looking projections?
I mean, this is a question I've been asked many times over, the 20 years I've been doing this. It's the REIT goes back to 2009, but the firm goes to 2003. And look, the simple answer to that is, when I'm asked about returns, I always say the same thing, which is 7 to 12. Irrespective of the fact that I've outperformed that, I'd rather under promise and try my best to over deliver.
Mm-hmm.
So that's my response to that question, be 7 to 12. What leads me to believe that forward-looking returns will still be positive? I can't assure anyone they'd be 14, but what do I think? Why do I think they will continue to be the case, or high positive returns? Again, a lot of those tailwinds continue to exist. In fact, in many respects, they've gotten worse. So the inflationary tailwind is stronger now than it was 10 years ago when I started this business, right? So we've moved from, call it a core inflation of 1.5 to 2.5, and here we are at 6. And I think in the end of it, in a decade, we'll be very, very pleased if we got down to a 4 average. And that's kind of my base case. So I think inflation is going to be high. The second thing is, Canada's had a very strong focus on positive in-migration. And if anything, they are now bringing in far too many people too quickly and faster than the infrastructure and services can evolve. So anyone who doesn't have a doctor and has tried to get one knows this. Anyone who's tried to buy a condo or a home or even rent an apartment knows this all too well too. And there seems to be no political will to either shift the focus of immigration to people who can, for lack of a better word, swing a hammer to help us fix the supply issue, B, maybe reduce immigration to a level that the country can adjust to. So not only our industry, but every industry can adjust to, particularly healthcare, I would say the two top. And the third is, there are so many constraints to building new supply in this country. And I do not believe even, the federal government can barely even acknowledge that there's a housing crisis when everyone who's read any news at all knows that there is one. So I don't believe that there's the political will to get it done. And that's why, my forward-looking forecast is this is still a pretty good business to be in and will be for quite a while.
Mm-hmm. Yeah, that's definitely good to know. And with the influx of immigration, is that one of the main drivers that you see holding rents up at the rates they're at, or bringing them higher?
Well, so this is certainly a very large cause, right? So it's not the only one, but if you think about supply and demand, right? So, and if you've ever been to Toronto, where our head office is, and you look and you see towers everywhere, you should just think this torrent of supply. But the torrent of what appears to be a torrent of supply, there's better words for it, is not really, considering how much is coming down the pike in terms of immigration. So that's just one aspect. But getting apartments built in this country is so difficult and so expensive. So let's think about it this way. In Canada, there are so many regulatory hurdles, not only from the municipal levels, the provincial, and also the federal, that it takes, from the time you buy a site to get it to permitted to ready for a move-in Canada averages about 100 months. Now, it's very different across depending which province you're speaking of, but 100 months is a really long period of time. Whereas, in projects in the US, you can probably do that in about a quarter of that time. So the market is far more responsive. And you think about this from all right, well, if you're a developer and you have to put your money out, and you can do it in a 2 years time span, you can take I wouldn't say very little risk, but you can take much less risk to costs or the market changing on you, government policy changing on you if you can build in 2 years, whereas in Canada you have this full cycle. So you not only need to have your money out longer, which means you take more risk, and you need to earn a return on that money for 8 years instead of 2 of development period. So these regulatory restrictions are constraining supply. Then you look at it from a similar angle, which is government fees and charges, depending again which province you're in. But let's call it about a third of the cost of building a new home today is government fees and charges. So, part of this real problem is a funding one, right? The municipalities have gotten themselves so beholden to property taxes and land development charges that they can't afford to give those up. But at the same time, because they refuse to give it up, they're only going to get a kind of product which can make the economics work, which is condos for what I would call, lack of a better word, rich people. And it's very hard to compete an apartment in a location downtown where it's going to take you 8 years of time, effort, and capital, and you have to compete against a condo developer who's going to reduce his risk by selling the asset off to individual buyers. So there's just all these structural impediments that make it really hard for this industry to provide the supply, which could potentially reduce the pressure on inflation. And quite frankly, I just don't believe that the political will is there to get it done, because it's going to involve significant incentives to do it.
Okay. And something you brought up there about the supply, because when you have new investment dollars coming into the Centurion REIT, you need to find places to allocate them. And one of the things that we appreciate about Centurion is you've actually had periods where you'll close to new investors. You won't accept any new money because you want to take care of the existing dollars. Can you tell me a little bit about how that comes up for you?
Sure. So we're always, trying to manage the liquidity and taking in, it's a process where every single day I get a projection of where our liquidity is, and this factors in, purchases that we have contracted to, things that we might contract to, things like refinancing, so new money that's coming in or going out from a financing. New money that's coming into the fund, or we anticipate to come into the fund. And then we're always doing this projections that go out months and assessing what is the net flow in and how is that going to be allocated? And do we have enough that we find to be attractive at any given point in time to say we'll still accept capital? And so sometimes it happens that, we have an investment that comes back, and then all of a sudden we've got a whole bunch of cash, which we didn't anticipate. And then we're like, okay, well, we don't want this to be dilutive to existing investors. So we'll cap off the fund until, we found investments that meet our criteria and on the timelines. And sometimes that can take some time.
Okay.
Right. Yeah. We're not a money market mutual fund or a stock market fund where we've got, here's our 20 stocks and money comes in, we just hit the button and it allocates to those 20 stocks in our chosen ratio. No, we actually have to go out and, find an asset in a target area that we like, that meets the quality specifications that we have, that meets the return expectation, like all of these criteria. And that's a real sorting process and takes a lot of time.
Okay. And just changing gears just a little bit, I was reading a report that you put out around this time in 2022, and there was a quote from there which I liked. Just right here. Let me just get it on the screen. And it was talking about real returns after inflation. And you said, if you want a 2% real return after inflation, just to lock up your money for 10 years without access to it. And when inflation's 2%, without taxes, you will expect a 4% rate of return, 2% for your real return, and then 2% goes to inflation. And then if you add taxes into the mix, the math gets even more complicated. At a 50% tax rate, to earn a real return of 2%, at 2% inflation, you need to get paid 8%, because 8% in interest, 4% goes to taxes, 2% goes to inflation, and then you're left with your 2% real return. And that was last year. So we're looking back at 2% inflation, and it's a lot different today, isn't it?
Yeah, no, and I've been talking about this in a couple of papers I've published since really the summer of 2020, so almost 3 years ago, when, basically I shifted my forward look for the next decade from a disinflationary one to one that would be inflationary, stagflationary. So that makes it very challenging, certainly for investors. And one of the reasons why I think it's really important that you have to have not only return or real assets that correspond or protect you against inflation, but to the extent possible, if it is possible, that those returns be tax efficient, right? And this will help you keep up with inflation, because you look at, people think, oh, well, yeah, I can get 4.5 and putting it into T-bills or something. And I said, well, that's just inflation. And if you take the tax, because you're going to give away half of that in tax, you're -2. You're not, it seems juicy, but it's -2. It's not that attractive.
Yeah. Because any T-bill, you have to pay tax on it, and you only get half that return take home, and inflation stays. Yeah. And then could you just talk at like a high level, without getting into too deep in the weeds, about the tax efficiency of your fund?
Yeah. So, this is not, I think, just unique to us, but it's unique to real estate as an asset class. About 80%, give or take, and there's a wide berth, right? But about 80% of what a building is building, bricks, mortar, all those kind of things, windows, boiler systems, and about 20% is land. 10 to 20% is land. And that land you can't depreciate, but land, buildings, etc., earns depreciation, or you can claim depreciation. So from an investor's point of view, what you're getting back is much of the return is going to get treated as return of capital, because you're getting that offset from capital cost allowance, or depreciation, for lack of a better word. Now, that doesn't mean you're paying no tax. It just means you're tax deferral for the most part. And, and it's capital gains when you take it, as opposed to income gains. So it's those kind of two angles help. I believe the cash flow is tax efficient. The growth is tax efficient and deferred. So all of those are benefits that don't necessarily apply in most financial products, right?
Right. Right.
And certainly not bank accounts or bonds.
Yeah, absolutely. And that's one of the things that our clients that are nearing or in retirement really like about this investment is, you're getting, is the yield or yield that is paid out through this around 5%?
Yeah, so it's just a little under that, but approximately that, yes.
Yeah, around 5%, and most of that's paid out as return of capital, which there's no tax due while that's paid out.
Yeah.
And then eventually you pay capital gains down the road. So that's been an aspect that investors absolutely love about this product.
I think that's very true, and that's very common for a very large subset of our investors.
Yeah. Okay. And then just when we're talking about REITs with a new prospective client, they'll say, "Oh yeah, I have REITs. I have Canadian Apartment REIT," and they'll list off a couple of REITs that they have, and often those are publicly traded REITs that trade on the stock market, where yours is a privately traded REIT. So as a CEO or a founder, Why do you choose to run a privately operated REIT as opposed to a publicly operated REIT? And what's the benefit to an investor in investing public or private over public?
Okay, so there's a couple of questions in there. I mean, one of the challenges I think and this is just generalized, like, why would an investor benefit from having a lower volatility type return from a private investment than the volatile stock market? Aside from, the obvious, which is the sleep at night factor. But I think that the sleep at night factor is as much as we talk about it, is underappreciated. I think a lot of the mistakes that people make as an investor is they panic when things get bad, and they panic on the reverse side when things are going too well. And so they're getting in exactly the wrong time in the cycle. And it's investor psychology. And I think investor psychology is a huge portion of, long-term success if you're able to divorce yourself from those. So if you look at those two buckets and say, here's the private, here's the public, over a 30-year time horizon, I think the returns between those two pools, all else equal, should be similar. Mm-hmm. But your experience as an investor may not be, because you might panic out of one of those REITs or any investment. So I think our type of product is really designed to provide people with the exposure to the asset that they want, which is the apartments, the return, without necessarily doing the extra stock market volatility overlay program that not everyone really wants, but might have to accept if they buy into a publicly traded REIT. Mm-hmm. It's not to say that publicly traded REITs are bad. They're not but it's I think for us, being able to offer this has put us in a really coveted position, right? There's not a lot of quality products in this space. And, I would rather be one of a few and offer something that I think a certain subset, I'm not saying everyone wants this, but a certain subset of the market wants. And we can make a really good business case for fulfilling that need for that subset of the market that wants that smoother portfolio experience than stock market volatility. Okay. Yeah, it's a complicated way to answer the question, but I think that's good.
No, I think that's fair. And, so the publicly traded REITs are valued on what people are buying and selling them for on the public stock market. If there's a lot of excitement or positivity, they'll go up pretty quick. And the same way they can go down when there's fear out there in the market during COVID or more recently. Right. And then where your fund is valued as the net asset value, and who comes in and how often to value your investment fund?
So we do a quarterly process. So every asset, or 98% of them, get valued every quarter. Yep. And we have either appraisers who are coming in and saying, here's the capitalization rates for every single asset, and get a singular report for that, or we're buying a new asset or refinancing an asset, and so we've got a specific building appraisal for that at the time. But it's although we do post a NAV every month in practice, yep, it really changes every quarter.
Yeah, and I don't have the monthly up on the screen, but when you look at the monthly returns, you can see that come in, on the quarterly basis thereabouts.
Yeah, that's right.
Okay. And when you see all the different areas that investors can allocate to, like, do you know, like, your common investors, what percent they're allocating to a private REIT or a REIT like yours?
Well, that's really hard for me to say because, we have allocations from portfolio managers or from family offices or institutions where, I do not have the KYC or the know your client data. Right. So it varies dramatically, not only by investors and what's appropriate for their own portfolio and their own risk tolerances, their own liquidity requirements, but it also varies by dealer, or what I would call like portfolio managers. Some say, well, alts we're happy with 20%, and others are alt heavy, so there's 60% or 80%. So the weightings will be vastly different, and institutions are a whole new bag all on their own. So I hesitate to say that there is a singular number that applies to anyone.
Yeah, gotcha. Yeah.
Sorry, that's not a great answer, but that's actually, I think, the one that's probably most appropriate.
Yeah, and I appreciate an honest answer there too. Well, I think we covered most of the points that we wanted to get to today. I know your time is very valuable, and we really appreciate you taking the time to come on here with us and share some of your insights, because I know you've got a wealth of experience in the industry, and your track record speaks for itself. So I just want to say thank you very much, Greg, and I hope we get the opportunity to interview you again someday.
Be happy to do it.
All right. Thank you. Take good care.
Thank you. Bye-bye.